Welcome everyone, this is John Sheely with Traders Country Club. In this section, we're going to take an in-depth look at moving averages. But before we begin, we must make a few disclosures. There is risk of loss when trading in any asset class, including stocks, options, commodities, or forex currencies. Past performance may not be indicative of future returns. And please consult with a trusted advisor before you engage in any trading activity. And always, never risk any of your funds that you cannot afford to lose. Additionally, during the course, I will post or display performance results from backtest and other research. These trades are entirely hypothetical and were not achieved in a real and funded account. These results are presented solely for the purpose of demonstration of historical research for a variety of price patterns or technical indicators. This section will take a close look at moving averages. I know that almost every student probably knows what a moving average is, but we're going to take a more critical look at this popular indicator. As you look at this chart, you will see that prices changed from a bull trend to a bear trend. But when and where? Many traders use a moving average to help in answering this question. I have now placed a 40-period simple moving average in the chart. You can see that except for a few minor violations, price stayed above the moving average during this bull market. But then prices began to stay under the average as the bear market began to develop. This is the general purpose of the moving average. But what period of moving average should I use? In this chart, I have 4 moving averages. I have a 10-period moving average, a 40-period, which is popular among commodity traders, the 50-period moving average, which is popular in stocks, and lastly the 200-day moving average, which is also watched by many traders who trade stocks. Let's start with this proposition. If I'm going to use a moving average to warn me of a potential change of trend, then I should select a moving average that is not easily violated by price and is not violated by price on a typical market correction within the trend. With this understanding, a 10-period moving average is too small a time period. Even small corrections within a trend cross the moving average constantly. Because of this, a cross by price of the 10-period moving average means nothing. Now I can select the 200-day moving average, but by the time price reaches this average, the trend changed direction long ago, and I have missed much of the trend if I wait that long. I need to select a moving average that is not too close so that prices constantly generate false signals on a single cross of the moving average. I don't want to pick a moving average that is not too far because I'm going to give up too much trend opportunity. I need a Goldilocks moving average, one that is just right. In the search for the perfect moving average for this selection, some traders believe that an exponential moving average, which places in its calculation more weight in more recent closes than a simple moving average, has an advantage as a tool for this purpose. You can see in this chart that these two averages are not significantly different. One may have an advantage on one occasion only to be a disadvantage on another. As we discuss moving averages as a trading signal, profitability is not significantly dependent on the kind of moving average that is selected. Let me highlight this point. In this chart, I have the traditional 20-period simple moving average and a 20-period exponential moving average. I also added a 25-period simple average that has been displaced backward by 5 days. In other words, I have manipulated an entirely different moving average to generate almost the same information in regards to trend as the other moving averages. This leads to several generalities that we can make about all moving averages. Our goal is to select a moving average where a cross of the moving average by price means something. We do not want the average correction within a trend to constantly violate our moving average selection. This would lead to many false indications of a change of trend. We do not want to pick a moving average that is too far because we would give up too much open trade profit if we were in a trend position waiting for that longer term signal for a change of trend. There is no perfect moving average for this purpose. In general, you want to pick a moving average that avoids most corrections and then stick with it. Now, I'm going to be illustrating the use of the 50-period moving average most often because this is the most heavily watched moving average by the public. Yet, I've known many traders who use a 28 or a 30, 34, 40, and a variety of other moving averages for their personal selection. When you do hypothetical backtest on a selection of moving averages, there's no one moving average selection that is significantly better than all the others. On some years, for example, a 34-period moving average may have better results than a 40 or 50. And yet, on other years, a 40 or 50-period moving average has better results. There is no one single moving average that has a significant advantage over long periods of time, as long as the average that you select avoids the typical market correction within a trend. I just mentioned trading signals. Exactly what is a trading signal to buy or sell when you use a moving average? We're going to examine whether a cross by price above or below a moving average can be used as a trading signal to indicate a change of trend. I'm going to start with the signal that you hear about most of the time on television, the 50-period moving average. In this chart, I have placed a 50-period moving average, and you can see on the right that price just closed under the moving average. Here's the question. Should I sell any long position that I may have, or should I go short with a new position just because we've had this single close below the popular 50-day moving average? If you watch much television and watch the financial programs, you will certainly hear many technical analysts imply that you should sell your position. Well, let's do a little research and see if that's correct. If prices really do have a history of moving lower because of that single close under the moving average, then prices would fall to a lower profit target more often than they would rise to hit a higher stop loss price. If prices had a tendency to fall, I could actually go short and make a profit over time. However, where do I place my profit target and where do I place my stop loss? If I research this possible trade signal, I would test this signal over many years in different stocks and commodities. Because of this, I cannot use price as my targets and stops because of the reasons we've already discussed. However, I can use the standard that we established, average to range. I am showing an example of two short trades for the Dow Jones. Now I realize you do not short the raw index I have shown here. You would use other instruments such as the $5 Dow futures contract or the Diamond ETF. But I just show this chart for illustration purposes. You see, in June, a single close below the rising moving average. For this test, I'm going to go short in the close, and I will close out the trade if price falls by 2 average to range to take a profit, or I'm going to close the trade out at a loss if prices rise by 2 ATR. You can see in the first sell in June, prices did not fall, but rose first to hit the 2 ATR stop. In the second sell signal in August, prices did fall and reach the profit target. However, instead of just looking at a few trade signals, let us look at every short trade for the past 20 years. In this slide, I'm only focused on the sell signals for the Dow Jones Industrial, the SPDR for the S&P, and the stock Apple for the past 20 years. We are looking at the hypothetical results of selling when there's a single close below the 50-period moving average in a well-recognized bull market. So as you can tell, I did set up some test in the algorithm that I was only interested in a sell signal when there was a bull market, and therefore I ignored flat market conditions. So what do we see? The amount of the negative performance is not the primary focus. Take a look at the percent profitable. This is the percent of time that price fell by 2 ATR versus rose by 2 ATR after each time there was a single close below the 50-period moving average. As you see, the odds were less than 50%. Now what does this mean? In a bull market where the 50-period moving average is rising constantly, if there was a single close below the moving average, the odds were actually higher that prices would rise in the future, not fall. Now let's look at the same test in a few commodities. Now I'm making the test with the same rules. A rising moving average with a short position placed on a single close below the moving average. Once again, we set a profit target of 2 ATR and a stop loss at 2 ATR above and below the entry price. Let's see the results. So once again, let's focus on the percent profitable. Just as we saw before, the odds are that prices will rise, not fall. Now, what are these back tests telling us? If you're in a long position, a single close under the 50-period moving average is not a reliable signal that there's a change of trend. When there is such a close, there's a tendency for prices to rise in the short term, not fall. What about other moving average periods? They all tell us the same story. A single close across the moving average does not indicate a change of trend. Actually, this was known some time ago. This is when moving average systems began to be developed. Instead of a buy or sell signal being generated on a single close being above or below a moving average, what about if a smaller short-term moving average crosses above or below a longer-term moving average? Can that be a reliable signal to indicate a change of trend? Well, many combinations were attempted as the new age of computers began to facilitate this kind of research. One of the first methodologies sold to the public was the 5 and 20 system. It was simple enough. You sell and go short when the 5-period moving average was less than the value of the 20-period moving average. In the chart, the 5-period moving average would appear as if it was crossing under the 20-period average. If the 5-period moving average crossed over or was above the value of the 20-period moving average, this would be a buy signal. You see a few buy and sell signals in this chart. Now, how did this methodology perform if we do some research? Let's see in the next slide. The results that you see are for a stock index for over a decade. Now, I want you to focus on just a few items in this hypothetical result. Notice that the total dollar number is positive. That's the all trades result. So I'm not telling you that you're not going to make money from a moving average system. No, you can get positive results. But notice how often the moving average system had a winning trade. About 40% of the time. That's relatively low. This statistic is about right, by the way, for all mechanical trend-following models that do not employ a money management strategy at the same time. They win less than half the time. Now, because there are, in this kind of model, a low percentage of winning trades, they have a large number of consecutive losing trades. This is simple mathematics. Now here in this model, there was 9 losses in a row during this decade. This also caused a very large equity drawdown of 33,531. That figure is at the bottom. That is more than the total profit that was actually returned from this moving average system. Now let me show you another performance of the SPDR in the next slide. Now we see the same 5 and 20 moving average system for the SPDR. The chart on the left illustrates the moving average buy and sell signals. Once again, we have a very low percent of winning trades, but we have also a high number of maximum consecutive losses, and in this case, an actual loss in total performance. I show you these results for one purpose. While I can tweak the parameters for a moving average system of this nature to improve performance, this kind of trading approach will still have a poor performance relative to the equity drawdown that occurs in a flat market condition. This is not the way to trade the equity or commodity markets. In this chart, I've highlighted the slope of the moving average. When you have an excellent bull trend, the slope of the moving average will rise bar after bar. When you have a persistent bearish trend, the moving average will constantly fall. Noticing the slope of the moving average also gives you an excellent sense of trend. In this chart, I'm demonstrating one of the most popular uses of a moving average. The value of the moving average can serve as a price area of support or resistance. I say price area because sometimes price can pass through a moving average to a small degree. One popular way to define this zone of support around the moving average is to plot three moving average. One moving average of the highs, one moving average of the lows, and then the standard moving average of the closes. This establishes a range of prices for this zone of support, as I illustrate in this chart. Now, I admit that this is where the herd effect of thousands of technical traders may come into play. There are so many who watch this price area that a self-fulfilling prophecy can occur, and you actually see this in the chart example. This price area can serve as resistance as well. You see this on the chart on the left of the spider during June. This same area became support later in July. In the chart on the right is the euro-dollar forex currency pair. The 4-hour chart is very popular in forex, and you can see this moving average zone served as support in late September and early October. To summarize, moving averages are probably the most popular and heavily watched technical indicator of them all, and they're available on almost every charting platform. There is not really a perfect moving average for all purposes. If you're going to use the moving average as a broad sense of trend, then try and pick one that avoids the average correction. While many people compare price to the moving average to get a sense of trend, another way to use the moving average to get a sense of trend is looking at the slope of the moving average. We saw that a single cross of the moving average cannot be used as a reliable indication of a change of trend. This includes a single close above or below the popular 50-day moving average. The research that I previously described was whether a single close above or below the moving average is a valid indication of a change of trend. Now, while it's true that one or two closes above or below a moving average is not a reliable signal, a trade signal can be developed if you begin to have several closes occurring on the opposite side of a moving average. I will demonstrate that potential trade signal later in the course.